Hello everyone, this is Pierre Guivir for the Liberty News Network. Today I'm talking with Mark Thornton from the Mises Institute. He's here to talk about the present euphoria in the economy to know if it's real or if something is underlying. Hello Mr. Thornton.
Hello PG, great to be here with you today.
Thank you. So, the Dow Jones now broke a new record at 21,000. Confidence in the market seems to be high from businesses and consumers alike. Is the Trump effect real or there's something else under it?
Well, there may be a little something to the Trump effect. People in the United States really didn't like Hillary Clinton, and they were looking for something new. Trump may be not the most ideal replacement, but I think there was a general feeling of relief on the part of some Americans and just the opposite for other Americans who were supporters of Hillary Clinton. The main fundamental reason why the stock market is so high and stock markets around the world are so high, and this is just straight finance 101, is ultra low interest rates. Whenever interest rates go down, land prices go up, real estate prices go up, stock prices go up, bond prices go up. And of course, you know, in the United States, the Federal Reserve's interest rate level is less than 1%. And that's true of all the major central banks around the world. So that's the primary driver of the stock market. And the fact that Janet Yellen and the Federal Reserve have not really rushed ahead with increasing its policy rate. And so relative to expectations, interest rates are still ultra low in the United States and around the world. And the Trump effect really is a minor effect, and you can see it helping bank stocks. You can see it helping construction firms, people who work on public highways and bridges. And so you can isolate the Trump effect, like companies who provide, you know, cement and rock and all that kind of stuff. You can see a bump in those stock prices, but the overall euphoria in asset markets is artificially driven by central banks.
But you say that everything is going up. But usually when people think of low interest rate, they might think of high inflation. So why aren't the prices suddenly increasing?
Well, you know, if there's more money, prices are going to increase. The question becomes, what prices are going to increase? That's the key issue. Mainstream economists look only or primarily at consumer price indexes. Which is a basket of goods that consumers typically buy on a regular basis. But the money that the Federal Reserve lent into the economy was lent to banks. And so that money has found itself flowing in the direction of financial markets and not into consumers' pockets. Consumers or workers have not seen any significant pay raises in many years in the United States. And so the real median income of Americans has actually declined in recent years. And so we wouldn't expect, at least at this point, for consumer prices to rise. What we would expect is for asset prices to rise just as they have. And so it's not a real mystery at this point because Austrian economists follow the money where it goes. We don't look at one general aggregate statistic. We look at markets over time, and we look at different markets over time, and we're getting more or less what we've been expecting, which is higher asset prices and a stagnant consumer. Now, of course, some consumers are doing very well. The wealthy, the rich, people in financial markets. There certainly are some people who are doing very well, and we know that by looking at the high-end art market and high-end real estate markets in Manhattan, which have been booming, both contemporary art at auction and Manhattan real estate have skyrocketed in price, and only recently has real estate prices in Manhattan seems to have leveled off some.
What other assets would we see a price increase in, other than real estate and fine arts?
Well, there's a lot of markets. I've already mentioned stock markets and bond markets. Land prices have gone up significantly in the United States. I don't follow that statistic for other countries. But we do know real estate is booming in the United States. They're building a large number of homes. Real estate prices in New York and Washington, D.C. and San Francisco have risen dramatically since the crash after 2007. And then, of course, we've seen certain markets within the stock market doing incredibly well. And I would include here most especially social media and internet-based sales companies like Amazon, technology stocks such as Apple and Google. Those are areas where interest rates have been particularly helpful in building out Google's business and building out Amazon's business, and of course in social media and many, many other areas. Stock prices seem to be incredibly overvalued if you compared them to a normal market environment with normal interest rates and without such a lopsided outcome in the economy where you have people who are enormously wealthy and then other people who have actually seen their standard of living decline over the last 15 years. So that's very significant. And of course, today we just had an initial public offering for Snapchat or Snap or whatever it is. I can't even remember. I've never heard of it before. But they, at their initial public offering of stock, they raised $24 billion, or excuse me, they raised less than that, and it created a market value of the corporation of $24 billion. And the people who led that project are automatic multi-billionaires. So that's where the euphoria really is significant, and that's where you're seeing the types of things we see in a bubble, and that's, for example, corporations building new, lavish headquarters for themselves. And, of course, Google and Facebook are on enormous building program out there in Silicon Valley. And Apple is creating, it looks like a giant spaceship out there. And it's fitted out with luxury facilities. So when you talk about the cafeteria at Apple, you're really talking about multiple cafeterias where high-end food is being served for free to the employees.
How would you compare the present bubble, since you used the word, to the bubble of the early 2000s?
Well, that's a very good question. With the bubble of the early 2000s, the bubble itself was relatively confined, and it was confined to the housing sector. And so we called it the housing bubble. Some bubbles don't have that defining characteristic. For example, the previous bubble was called the tech bubble, the dot-com bubble. It had various names related to technology, and certainly technology was the biggest piece of that American bubble, but it wasn't the only piece. And so this one, I'm not sure what we're going to end up calling it. Probably be related to whatever companies and industries that fail the worst in the aftermath of this bubble. We might call it the social media bubble. We might call it another technology bubble. it's a little unclear to me at this point, because historical labels are only given after the fact. And so, for example, very few people were talking about the housing bubble when it was actually happening. I had a couple of articles on it. Later, we had some other people writing for Mises who talked about it and identified it even earlier. And then, of course, Peter Schiff and a lot of others came to recognize that bubble for what it was. And because it was so concentrated in housing, we were able to label it the housing bubble. But that's a very rare occurrence. And some bubbles, through historical accidents, don't get labeled at all.
For example?
Well, there was a bubble in the United States during the beginning of World War I. And so there was a bubble in the economy, and in 1913, the U.S. economy started to crash. But a few months later, World War I actually did break out. And of course, the Europeans who were initially engaged in this war, they needed food and they needed weapons and they needed all sorts of raw materials in order to fight that war. So the fact that Europe was at war helped drag the U.S. economy out of a crash, which otherwise would have occurred and would have gotten some kind of historical label.
Is that the crash that actually happened around 1920?
Yeah, and then after the war, there was a crash as well. And it's called the Depression of 1920, 1921. And it's really the after effect of that earlier bubble, because with Europe at war and the U.S. really barely engaged in that war later, we were supplying grains and farm products. We were supplying steel and weapons, munitions. And so that really, and then it was helped by being financed by the Federal Reserve. And so the U.S. economy was doing incredibly well. And then when peace broke out, I think in 1919, and Europeans went back to work, plowing fields, mining the mines, making and manufacturing products, all of a sudden the demand for all the U.S. products evaporated, the prices fell, and a lot of people lost a lot of money in the U.S. as a result.
You're the creator of the Skyscraper Index. Could you tell us a little about it and how are its indicators right now?
Well, I didn't actually start the Skyscraper Index. It was actually a financial economist named Andrew Lawrence. Most of the business press at the time, which is 1999, made fun of him. But I saw in his index the Austrian business cycle theory at work, at play, within that index, so that there was a rationale for it. And the index itself is the connection or correlation between the building of the world's tallest skyscraper and a significant economic crisis. And so I've been writing about this for quite some time, drawing the theoretical connections as to why we would expect a new world record skyscraper followed by or in line with a significant world or global economic crisis. And so Andrew Lawrence wrote that in the media in 1999. I published an academic paper on it in 2005, showing all of these theoretical connections. And then, of course, it led me to predict the sort of the end of the housing bubble when a new world's record was established in the Middle East, in Dubai. And so we knew before anybody else really suspected anything. At this time, which is the summer of 2007, stock markets were doing great, bond markets were doing great. The unemployment rate was in a good area, and so everything was going extremely well. When I began planning my own personal affairs for an economic crisis, which did transpire within a year. And so, and I've also backdated earlier economic crises and record-setting buildings. And so we're gaining confidence in the skyscraper index, including the one time that we didn't have the crisis, which was in 1913 when the Woolworths building established a new record in 1913. And so over time, we've been, looking at more data, and those data have been confirming what Andrew Lawrence first discovered in 1999.
So are there other buildings that are going to or have set new records since the last crisis?
Oh, that's a $64 billion question. There's a lot of building going on around the world. They're setting records for super tall buildings every year, and particularly this is noticeable in China. But the one building that is under construction right now that plans to set a world record is the Kingdom Tower near Jeddah, Saudi Arabia. It's going to be 1 kilometer tall, and which would, in terms of height, would smash the old record significantly. But in terms of usable, livable space, it actually only is taller by that criteria by less than 12 stories compared to the tower in Dubai in the Middle East. But they do plan to set a record. It is under construction. They are, making significant progress. I've already issued a skyscraper alert back in January of last year. It was clear to me at that point that they did the studies, for various technical reasons. They had plans, they had financing, and they were open about the fact that they were going to break the world's record. We're not there yet, and when we get to that level of construction and the record is technically broken, that's when we issue a skyscraper alert. And because at that point we should be expecting a world crisis between then and when the building opens, which is typically like 9 months to a year and a half before they actually open to the general public. But if the skyscraper index is correct, we should be forewarned about the possible consequences.
And so, according to you and what you see, how long do you think before the bubble pops?
Well, I haven't really been following the construction cycle too much lately. We're busy here at the Mises Institute with a lot of projects. We're getting ready for the Austrian Economics Research Conference coming up very quickly. We have the Summer Fellows Program. We have the Rothbard Graduate Seminar, and then we have Mises University. So it's a pretty busy place around here right now, but I do check it occasionally, and the last time I checked it, they were not even halfway completed in terms of just building the structure up. Of course, once you build it up, you've got to fill in walls and all sorts of systems, building systems, air conditioning, plumbing, and everything that goes along with that. And that's actually one of the theoretical connections, because if you build a record-setting skyscraper, you typically have to use new technologies, new techniques, new construction platforms. And so we can actually see central bank interest policy changing the technology and requiring manufacturers and builders to do things in an entirely different way, using new, future-oriented technologies that otherwise wouldn't be necessary and wouldn't be efficient as well.
Do you want to add something else?
Well, it's going to be very interesting to see how things turn out. The conditions that I see in social psychology and in financial markets and in real estate markets, you see the shows on TV here in the U.S. where people are flipping houses again. And so, the bubble fever in housing has returned to Las Vegas, and so it's really, in my mind, it's only a matter of time.
Well, thank you very much for this interview.
You're very welcome. I'd love to do it again sometime.